is that gold has had this big breakout above 3,500, which is what you mentioned was the inflation adjusted all-time high. And I think that's amazing to think about, that the market doesn't necessarily, subconsciously it knows what that level was. And we went right there back in April, and then we went into this what's called long base of consolidation. And then what we've seen is a breakout above it. Now, there's two separate ways to look at this. In the short term, gold has put in what we call a topping tail, which means we should be due for a small pullback, which, by the way, small pullbacks are natural occurrences within markets. It's actually healthy for a chart to pull back, or a commodity in this case to pull back. So this topping tail signals that we'll probably retrace. What is the downside retrace where I would start buying again? At 3,500. Former resistance becomes technical support when you break out and retrace. And let's be clear, we're likely going quite a bit higher on gold from here. And the fact is it's just the basis of the government is going to continue to spend. The Fed is continue to do what they've loved doing for ages at this point, which is printing money essentially and flooding the system in any downturns. And that is going to fuel gold higher, and likely, in all fairness, probably down the line Bitcoin as well. And that's a great point. So 3,500 right now is the line in the sand that I'm watching. But there is always a chance when you've had something like gold run up as much as it has, you could go a little bit lower. But I will tell you this: there's a beautiful downsloping line and upsloping trend line here. It basically, at this point, I have a hard time believing gold would pull back lower than, let's say, 34 to 3,300. There's just way too much support now in this chart, in this zone, that as long as it holds there, you're buying it, at that pullback level. And that's exactly what I plan to do. So again, yes, in the near term, I'm a little like, again, if you say, well, where do you see gold in the next 2 weeks? I think gold comes down. I think it pulls back, natural occurrence. But if you ask me in 6 months, is gold higher? I do think gold is higher. Now, a lot of people are always asking, okay, well, what's your upside cycle target? Well, where could this go in the interim for upside? And I think to do that, what you do is you use what we like to do in the technical world, is you use essentially a parallel channel, right? And we start to look at parallels here. And I would say by end of this year, I would not be shocked to see 3,800. Now, that's not the cycle top, but I think 3,800 is likely your upside parallel trend line of resistance. So I think by year end, 3,800. And then I think you're talking in the next couple of years, well over 5,000. This is what's called a wedge pattern. Now, upsloping wedge patterns, as they get tighter, it contracts and kind of makes a pressure cooker of the market. In other words, it's putting the market tighter and tighter, ready to explode in one direction. I base my analysis off probability. And when you see this type of pattern, this is a pattern that is basically winding a spring ready to break in one direction. This pattern formation has a 70% chance of breaking to the downside. If that happens, it's not just going to be a small move. It's going to be a major move to the downside. So again, this is just the S&P. You mentioned the insider buying and selling. That is an unbelievable, scary chart, and it has gone on for months. The fact that we have been seeing more and more of insiders just dumping, and we're talking Jeff Bezos, billions of dollars. Now, you could say he just wants to buy another yacht. Okay, that's fine. But what about other insiders? Yeah, so this data shows us, and this is just the last 30 days, but if you were to look at the last 6 months, it almost looks identical. And the green obviously represents the buying, the insider buying. And remember, when it's an insider, it's basically a CEO, CFO, CTO, COO. I mean, these are people with intricate knowledge on their business. And if they are dumping like this, number one, why are the markets still going up? Because you have retail FOMOing into this market. But it tells you their viewpoint on where they think their stock is valued at. And they obviously wouldn't be selling if they thought their stocks were undervalued. I mean, that's just common sense. And so, I'm all about breadcrumbs, right? You want to take each little breadcrumb and put it together. And once you start getting a mountain of breadcrumbs, you have to start paying attention. And there's so many of these signals out there that just continue to ramp up. I mean, you've seen Benioff sell with Salesforce. He's been unloading now for quite some time. Zuckerberg has been unloading. And obviously, those are the names we all know. But needless to say, it's not just those. I mean, you look at other major players out there. I mean, even Jensen Huang is unloading some of his position. Now, you could say, again, some of these guys just want to take some money out and kind of pocket it, if you will. And no one can blame them for that. But again, when you see it this lopsided, right? That chart we just looked at was massive red almost every single day, and you can barely see the green, and that was just the last 30 days. Imagine that chart going back 6 months of that every single month. There's a trend there, and these insiders they know exactly what they're doing. Let's be fair. Yeah, so this data comes, so every time an insider unloads, sells, or buys, they have to report it, right? Because they're an insider, they have to be tracked to make sure they aren't doing something illegal, right? So for instance, there's a quiet period just before a company reports earnings where insiders are not allowed to unload their stock. They can't buy or sell because the idea is they know what their earnings are going to be. And so 30 days prior, they can't do it. But once that passes, they can do anything they want. They can buy, they can sell. And what we're seeing is just massive amounts of selling. And so each candle represents literally hundreds of millions of dollars potentially. I mean, here you're talking talking about this one over here is over $3 billion in insider selling on this one particular day, which looks like the 10th of September. So just literally a couple days ago, there was over 300, actually it looks like $4 billion worth of insider selling. And then you just basically, when I look at this, and to be fair, I don't necessarily care how much on each individual day. I look at it like a bigger picture. Like if you just step back and look at the combination of green versus red. Now, if this was an average market, we should see a combination equal, about the same amount of green and the same amount of red. But instead, this is like 50 times the amount of red or insider selling than there is insider buying. And again, investors really need to pay attention, right? I mean, think about it from any of our perspectives. If you're the CEO of a company and you believe in your company and you believe that your stock is going to go higher and you believe it's underpriced, why would you be dumping this amount? Now, listen, everyone knows insiders will sell a little bit here and there. They want to buy a new yacht, whatever it may be. But this magnitude is alarm bells galore.
Mm-hmm. Do we know what they're using those proceeds to buy? Do we have any indication of that?
I don't think we actually know. I mean, again, we may hear Jeff Bezos has a new yacht, right? Like that's the common one.
Well, where are they parking their cash? Where are they putting the proceeds? Do we have any data that could point us in that direction?
I think the only data we would have in that scenario, if they end up owning a substantial amount of a publicly traded company, then it has to be reported like 10%. But anything less than that, they don't. But my guess is this is going into more conservative T-bill type scenarios that will just spit off an income. It gets them out of the risk. They know the market metrics, right? I mean, again, while markets continue to make new all-time highs almost on a daily basis, they are fully aware of valuations. They know the hype that's in the AI trade right now. They can see a lot of these CEOs are as old as me or older. They remember 1999 and 2000. I vividly remember that. And the insanity there is almost identical to what we're seeing now. That 911, obviously dial 911, but it came out 2 days before 9/11, which is even, again, I'm not a conspiracy huge person like that, but these type of things, it's just so weird. It is so weird. Yeah, so I mean, and that's such a big topic right now. Is it done deliberately or is it just an oversight? And I think we have to go to the root of the problem. And again, I'm not saying that there's nothing done deliberately out there, because there certainly is. But one of the things that drives me nuts is that the government sends out these surveys to companies and they say, hey, could you please let us know, are you hiring? Are you firing? Are you doing nothing? And there's a tendency if a company is hiring, they're quickly like, oh, yes, this is good news. Let me fill it out that we're hiring and send it back in. But if they're not, if they're firing, no one wants to write that in. Like, yeah, I had to fire 5 employees today or whatever it may be. And so because the government doesn't make it mandatory that there's a receipt of this data back to them by a certain date, there tends to be a lag on receiving this data, right? It's kind of like goes on the pile and the CEO says, oh, I'll do it when I have time. It's not great news. And I think that's one of the big problems. And it drives me nuts. If you and I get something from the IRS, they say respond by this date. And we all know if not, you're in trouble. With this type of stuff, there's no penalty. So like a company can just take their merry old time, yet the Fed is literally basing their decisions on federal interest rates on this data, right? We're all trading. Like as a trader, I am trading on this data. It needs to be accurate. The government needs to put a direct receipt date on it, like get this information back by X date, or there will be a fine. And I know that sounds crazy and kind of maybe a little ruthless, but when you have trillions of dollars being traded on this information, you have to have it accurate. Yeah, so I'm going with what the Fed Watch tool is saying right now. I think 3 rate cuts into year end, 1 at every meeting. I know after the last jobless claims shot up sizably to 263,000, which was dramatically higher than anyone expected, the markets kind of rallied on hopes of a 50 basis point. But this is the tricky thing. We are now in an official stagflation environment. And really, most media is not going to announce that, folks. But the definition is slower growth. And in this case, the labor market is slowing dramatically, and higher inflation. And we saw the CPI this week coming in at 0.4% on the headline. And just map that out, multiply it by 12. If that stays at 0.4 every month, we are basically at 4% inflation, if not even a little bit higher. And so that's the definition of stagflation, and that puts the Fed in a ridiculous bind. So yes, they will give you a rate cut coming next week, 25 basis points, probably 1 at every meeting. But the markets, in my opinion, have already priced that in. And my thing is this, I think we sell off next week. And by the way, late in the day on Friday, we saw some big accumulation in the VIX. The VIX is the fear index. It's basically below or was below 15, very historically low. And when I see that, it is a warning sign that institutions are starting to buy protection for expected volatility. And so ultimately, my expectation is a very hawkish Jerome Powell. Yes, he'll do the cut, but he's going to talk about how inflation is still an issue, and it's going to make the market rethink how many cuts next year they're going to get. Rally on rate cut expectations, the excitement of cheap money. But once the Fed starts cutting rates, historically, the markets actually go down. And the reason they go down is very simple. By the time the Fed actually starts to cut, the market is fretting that they are behind the curve once again, like the Fed usually is, and they need to cut more. But the Fed is very slow on cutting, and we're seeing that with the inflation numbers. The Fed will likely just cut one time at every meeting into year end. And so the market then starts to price in that things are a lot worse than expected and that we're heading towards a recession. A recession means lower profits and profit growth for companies, and PE ratios start to adjust. So be ready for that in this scenario. And remember, technicians like myself, we don't reinvent the wheel. We look at historically what happens every time. And if it happens every time, who are we to think this time will be different? A lot of investors out there will tell you, oh, this time is different. Well, I heard that in 1999 too. And then we saw 85% drops in many of the big name tech stocks then as well. Yeah, so I think the markets will start to see a top being put in here over the next week or weeks. I think it's going to be a choppy period because, again, we've lured investors into believing that every dip, even 1%, 2%, 3% dips are buying opportunities. But as that gets dissipated, as the investor starts to run out of investable income, that will then start to slide further and further south to the point where I do think you're looking at a 20, 30% correction into next year once again. And the difference here is everyone will expect it to rebound like after the Liberation Day sell-off, after the COVID sell-off, after even last in 2024, that August nasty sell-off. We came back to all-time highs. I don't believe that is going to happen. And I think, honestly, the market and maybe Fed officials and maybe government officials have done a big disservice to investors by luring them in. Since COVID, millions of new young investors have come into the market, and they now believe that the biggest correction they'll see, yeah, they might see down 20, 30%, but within 3 months, we're at all-time highs. That is not always the way. In fact, if you look back at 2000, when the NASDAQ collapsed, 15 years it took for it to hit a new all-time high. But I don't necessarily know if we'll be down that much in the next 3 months. I think it's early 2026. And the kicker is this, is that, again, because the markets trade on psychology, right? So you have the human psychology of, oh, it's a 3% pullback, let's buy the dip. Okay, so then you get a 2% bounce, right? Then you get a 5% pullback, buy the dip, you get a 3% bounce. And so initially when markets top, they tend to top with a lot of chop with a slight downward angle. And then eventually people start to say, wait a minute, I keep buying the dip, and then it keeps making lower lows. And then they stop buying the dip, which is when the downside accelerates. And that's usually the bigger move. So initially, especially the way the markets have been conditioned, you'll see sideways to slightly lower chop. Then the downside comes in probably in early 2026.
Right. So where are we in the fear and greed cycle right now? Because I know that is something you look at closely.
Yeah, and we are in extreme greed to the point where, I mean, when you see Oracle, and I'm going to show you guys a few charts here that just kind of blow my mind here. So let's look at Oracle, ORCL, 40%, actually was up as much as 40% on earnings. This company was valued at $700 billion before earnings were, it basically plummeted back down here. But when you see these type of moves where a company can gain that much, and again, by the way, you have to go back to the 90s, by the way, pre.com, the last time Oracle had a move of this magnitude. And that's very telling to me is when you start to repeat history, it makes me on high alert. But we see that Oracle's obviously coming back in. But then you have other stocks like QMMM. This stock in one day ran 2,700%. Now, all this company did was say, hey, we're going to put some crypto in our treasury. And investors rallied it 2,700% in one day. And again, you could go to many other names. Octo was another one this week. Octo rallied 5,600% in one day. And again, for those of you that have traded crypto, remember in 2020, 2021, or even prior to that, where altcoins were doing this type of massive move, and then the collapse occurred. And this to me is a sign of that kind of gambler's mentality that is so concerning in our markets right now. And again, just a couple other charts that I'd love to show you guys here. Because I do think this brings a kind of a more grounding perspective. And one of the things I talk to everyone about is just look for the breadcrumbs. And the breadcrumbs, while it doesn't tell you like on this specific date the markets will top, it gives you enough data to make smart decisions, right? And you might feel like, oh, I missed the run up or I missed, the last leg. But you know what? Protecting, at least for me, protecting my money is the most important thing. This is the S&P price to sales ratio. We are now at over 2 standard deviations away from the average, historical average. And by the way, we are more than in 2020, and that is astounding. Then we flip over to this chart. Here's the S&P 10-year PE ratio. 2 standard deviations above. Granted, not at the internet bubble high, but incredible how overbought we are in that metric. And then lastly, this one, guys, this is the Buffett indicator, right? So we all have heard about Warren Buffett. Buffett indicator is the ratio of total value of the U.S. stock market versus the current measure of total GDP. And look, we are now at all-time highs on this metrics. You can go back to the .com level. We're above that. You can go back to the 1970s. We are above that as well, right up there. And basically, I mean, just to summarize, when you're 2 standard deviations above something, it doesn't tell you, again, this date, we're going to reverse this second. What it tells you is you better be freaking on point because at some point the music is going to stop and the rug is going to get pulled. And the higher you get, usually the harder you fall. Yes, copper is definitely something that is getting my attention. This is just one more of the many charts that has my eye here. Now, normally, and listen, we're starting to see this labor market weaken, so it's starting to make more sense. But prior to these latest jobs data points and these revisions, everyone was saying soft landing, the economy is going to be fine, the Fed will cut, it'll re-energize. But look at this. Copper right now is trading at levels it was trading back basically a couple years ago. And this formation here in technical analysis is known as a bear flag. All right, a bear flag is a sharp drop where then digestion occurs. And in general, when this pattern forms, you get an additional move to the downside. And listen, copper, if the economy and the global picture was going to improve, copper would not be going down, or likely the chart would not be telling us it is going down. And the same thing for oil, by the way. If we flip over to oil, oil is in a treacherous scenario here where we are trading now at levels, basically you're going back to 2021, kind of in that range of where we were trading just before the COVID collapse. And again, if the economy and the global picture was looking amazing, you would not be seeing oil trading down here. And by the way, I'm looking at oil. We are now, and again, I'm going to get rid of these two trend lines. I want to show you this. You're essentially coming into a major support level around $58 per barrel. If that breaks, you're likely headed to $43 a barrel. In fact, that's my 2026 downside target on oil is $43 a barrel. And you're not going to be at $43 a barrel unless we're in a recession. Put it to you that way. So again, that does tell us that there is some major weakness here. And they are continuing to drive and keep the economy afloat. And then you have everyone else who doesn't have a lot of investments, who is getting crushed by inflation, who's getting crushed by housing prices and all of these other things. And they are already in a recession. In fact, you could argue they've been in a recession for a long period of time. So the only thing keeping this market or the economy afloat at this point is the stock market. And the question is, how long can the stock market keep going up for? If it goes up forever, okay, we're set. We're good. We won't have a recession. But if you get a correction here, you will see that recession, and the stock market will be the culprit. I'll tell you a story. So back in 2007, early 2007, I had some money that I was managing for some family members. And I wrote them an email and I said, guys, I'm really uncomfortable about what I'm seeing in the data here, in the markets and everything beyond. Things are not going to last. I think you guys should be very cautious here in your investments, right? And some paid attention, some laughed at me, and they said, no way. And literally it took a year. I was a year early before the collapse occurred. And in this scenario, in general, that's the hardest thing. You see the writing on the wall. The breadcrumbs lead you to that, but it ultimately takes longer. And it takes longer partially because the Fed is already starting to make money easier to get. Let's lower rates, more money in the system. The government has been spending hand over fist like a drunken sailor. That's more stimulus in the system. There's so much in the M2 money supply that it keeps things afloat. But the writing, again, is on the wall, and I'd much rather, at least for my own portfolio, and I can only speak for my own portfolio, I would rather be cautious and miss 10% of upside or 15% of upside versus giving away half of my portfolio in a major market crash.